Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 tech stocks that have dozens of Wall Street analyst ratings pouring in. So let's get into it. All right, welcome back everyone. Thank you all so much for being here. Today we are talking about some popular tech stocks among analysts. Now these 3 companies all come in as strong buys with dozens of Wall Street analyst ratings coming in. So we're going to take a look at these companies, what it is that they do, and what has Wall Street so excited about their stock's potential. Just before we get into all of that, this is your friendly reminder to make sure you've downloaded the TipRanks mobile app so you can access the wisdom of over 8,500 Wall Street analysts on the go. Links will be in the description down below. Now let's get into our 3 popular tech stocks. Today we are starting things off with Uber Technologies. The Uber stock trades under the ticker UBER, currently priced at $43.65 per share. They have seen growth of over 53% in this past year, and over the last 3 months have cooled off slightly, down over 7%. Uber, of course, is the well-known ride-sharing app. As the largest ride-sharing company in the United States, they match drivers and riders in more than 10,000 cities worldwide. The company has over 131 million monthly active users. They're also well known for their Uber Eats, helping deliver foods from restaurants all around the world. A 5-star analyst from JP Morgan just recently reiterated Uber as one of their top picks. They said that they expect the company to continue delivering incremental margins above their 7% benchmark as they track to be well above their $5 billion 2024 EBITDA target. They also think that new mobility products will help support mobility growth. Uber will be sharing their third quarter report here soon on November 7th, and this follows their second quarter where they saw record free cash flow of over $1 billion. For their Q3, analysts are anticipating earnings per share of 7 cents, a big year-over-year increase. In their Q2, they reported earnings of 18 cents per share, beating expectations by 19 cents. Q2 also saw their gross bookings grow 16% year-over-year. Management noted robust demand, new growth initiatives, and continued cost discipline resulted in their excellent quarter. Another analyst from BTIG reiterated their buy rating on the Uber stock ahead of this earnings. They said their buy rating is primarily based on the positive trends in the U.S. rideshare and delivery sectors, which play a significant role in Uber's performance, given that the U.S. accounts for about 40 to 45% of their total bookings. They also said that the relatively calm competitive landscape, as observed from discussions with other industry players, bodes well for Uber's position in the market. There are currently 30 Wall Street analysts weighing in on the Uber stock, and we have nearly unanimous buys with just 1 hold rating. That strong buy rating on the Uber stock comes with an average price target of over $58. That would be an upside potential of 34.5% from current prices. Down below, we can see our most recent ratings, including JP Morgan and BTIG, coming in with price targets with 28 to 37% upside. And we have several around that 37% mark recently. Scrolling back a few months ago, we do have that one hold with no price target, and again, a lot in that 26 to 37%. Our second stock that's gathering lots of analyst attention is ServiceNow. Their stock trades under the ticker NOW, currently priced at $552 per share. They've seen growth of over 45% this past year, cooling off a bit in the last few months, down 5.7%. ServiceNow offers enterprise cloud computing solutions. They offer a comprehensive suite of software solutions designed to streamline and automate various business processes. The company is known for their exceptional capabilities in IT service management, allowing organizations to efficiently manage and resolve IT issues, incidents, and requests. Last week, we saw an analyst from Goldman Sachs reiterate their buy rating. They said that the company's robust execution is expected to counterbalance a still cautious demand environment, as indicated by industry conversations. ServiceNow's third quarter results are anticipated to be solid, with subscription revenue and CRPO in line with their guidance. ServiceNow's upcoming third quarter will be following a solid earnings beat back in July. For Q3, they'll be looking for earnings per share of $2.56, a notable increase over last year's, and this follows Q2 where they reported earnings of $2.37 per share, well ahead of the $2.05 estimated. In that Q2, they did see their subscription revenues grow 25% year over year, and they exceeded guidance across all of their metrics and raised their future outlook. And we had another analyst from TD Cowen reiterate their buy rating just a few days ago. He said that their recently shared third-quarter reports show promising data points and high activity from the federal sector, which indicates strong year-over-year growth. Despite a recent decrease in investor sentiment, Derek did view this as an opportunity, especially as ServiceNow had just launched a new AI product. The U.S. federal data suggests a roughly 10% year-over-year growth for the third quarter, including a notable deal with the VA that seems to hint at a substantial increase in ACV expenditure. Once again, we almost have unanimous buy ratings on the stock. ServiceNow has attracted 27 current ratings from analysts with just one hold. The strong buy rating comes with an average price target of $641, which would be an upside potential of over 16%. Down below, we can see the recent ratings coming in this past week, a lot of them ranging from the high teens to low 20% upsides. Scrolling down quite a ways, a good 3 months ago, we'll find our low-end price target with this hold. And third up with the most analyst ratings out of our group today is Palo Alto Networks. They trade under the ticker PANW, currently priced just shy of $250 per share. They've seen growth just over 50% this past year and are up slightly in the last few months at 3%. Palo Alto Networks is a cybersecurity specialist. Their core product is a platform that includes advanced firewalls and cloud-based offerings that extend those firewalls to cover other aspects of security. The company offers real innovation in their firewall. Based on their patent-pending App ID technology, their next-generation firewall enables applications and scans content to stop targeted threats and prevent data leakage. Over the past couple of weeks, we've seen several analysts increasing their price target on the stock, one of them coming from KeyBank. The firm said that they have an increased confidence in Palo's ability to be a long-term consolidator of security and a leading beneficiary of the strong momentum in SASE. In mid-August, the company did come out with an earnings beat for their Q2. Their next earnings are coming up near the end of November, where analysts will be looking for earnings per share of $1.16. Q4 was back in August, where they came out with earnings of $1.44, beating expectations by 15 cents per share. And they saw their fourth quarter revenue grow 26% year over year to $2 billion. Palo Alto Networks has an impressive 37 current analyst ratings, coming in as a strong buy. With 33 buy ratings and 4 holds, the average price target comes in at $281 for an upside potential of 12.75%. But we can see the more recent ratings are actually a bit higher. Just a couple days ago, we had Robert Baird coming in with an upside of over 15%. We do have a couple holds, one with a slight downside, but then many others are north of the 20% upside mark. Going back a bit further, we can see those price targets getting a little lower as the stock has seen a lot of great growth recently. So there we have 3 strong buy stocks, all picking up dozens of ratings from Wall Street analysts. Let me know your thoughts on these companies in the comments down below. I always love hearing from you guys. And please keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are up to and providing some insight and entertainment. So please make sure you always stick to your own investment plan. Thank you guys so much for watching. I hope you have a great day, and I'll see you back here next time.